Dear colleagues, we are starting our webinar, which is dedicated to the issues of taxation as a part of our cycle, which is dedicated to the issues of corporate structuring and taxation in the countries throughout the world. Today, our focus is Germany, and we are very grateful that the team of the office of KRO in Hamburg agreed to join this meeting and to deliver information over corporate structure and taxation and possible additional issues regarding how to arrange taxes in Germany. No need to say that Germany is a very important country in the geography for our clients. And me and Leonid hope that this information will be useful not only in Ukraine or Estonia, but in the other countries of ex-CIS, which offices join our program to deliver webinars of such kind. We cooperate with Latvia, Litva, Moldova, Armenia, Georgia, Azerbaijan, Kazakhstan, Uzbekistan. So we hope that our colleagues or clients from these countries are also joined and can listen to the reports of our colleagues. Today our speakers are the specialist of Office of KRO in Hamburg, namely Matthias Linen-Kugel, Sven Oswald, Gerrit Widow, Arnett Groschke, and Eric Donke. Thank you once again, and I ask Leonid to proceed and to moderate our webinar as usual. Thanks so much.
Thank you so much, Dmitry, for introduction, but I think there's nothing to add from my side, and let's give the word and give a stage to our colleagues. So, dear colleagues, would you please start with the presentation?
Yeah, thank you very much, Leonid, and thank you very much to your offices to invite us to discuss doing business in Germany for the next about 19 minutes. And let me start by just briefly bringing some faces to the names that you just heard and the specialization. So I will do the introduction. I'm Matthias Linen-Kugel. I joined KRO Hamburg in 2000, and I am partner for transaction and M&A services. So then is followed by the corporate law section is Sven Oswald, then the labor law, Gerrit Widow, taxation by Annette, and audit and financial reporting by Eric. So these will be the major sections that we are going to present. And you will have the opportunity to ask questions in the chat room, which then Leonid will moderate. After each section, we will do the Q&A part through the chat room. So let's get right into it. Let me give some quick information about Germany and who and where we are. So Germany has a population of about 80 million. Thereof, there's about 20% of international migrant population. I think that's one of the largest shares in Europe. We now have the unemployment rate is currently about 6%, and the overall employment rate is 60%. And with a GDP of 4.3 trillion, we cover about 24% of the GDP of all EU countries combined. GDP per capita is about 70 million, and we are talking about 3 million companies established in Germany at the current time. KRO Germany has the strategy to cover all major economic areas in Germany. And just as it happens, we have our offices in all major economic areas in Germany. apart from Hamburg and Berlin, Düsseldorf, Frankfurt, Stuttgart, and Munich. In 25, we had about 170 million in fee revenue euros, and the current team is about 1,100 partners and staff. We are from the Crow Hamburg office up in the north, and we currently have about 450 of those 1,100 partners and staff. So that's the largest office in Germany is in Hamburg. Just some pictures about our office. So we are in this high-rise building in the on the bottom to the left. Crow Hamburg was established in 1928 and is located right in the center of Hamburg. It's the former building of the Spiegel magazine, which is under landmark protection. And you have some impressions about the with the photos above. Crow Germany covers a broad area of expertise, so not only accounting, tax, and legal, but also M&A services, all sorts of legal services in specializations, and financing, capital markets also, but also more recent blockchain and AI consulting. So we have a broad portfolio of services in Germany, and we were lucky in the recent past to win a bunch of awards in all different aspects, which underscores a little bit that we are striving to be a leading professional services firm in northern Germany. With this, I would like to turn to the next section, which is getting started in Germany, that is presented by my dear colleague Sven Oswald.
Thank you, Matthias. Yes, my name is Sven Oswald. I'm a corporate and commercial lawyer, one of the roughly 65 lawyers that we have in our firm. And I've been with Crow in Hamburg for the past 15 years. So half of my professional life I've been in this firm. I would like to tell you something about how foreign investors can get started in Germany. There are several options for conducting the business here. One, of course, is that you can open up a branch office here, or, and that's what most people do, you establish a legal entity in Germany. A legal entity can either be a corporation or a partnership. And the most relevant forms of corporations are the GmbH, the so-called GmbH. It's a limited liability company. Then there is a special form of the GmbH, which is called the UG. I will tell you a little bit more about that in a short while. And then there is the stock corporation, the so-called AG. As for partnerships, there are generally two major forms. One is the KG, which is a limited liability partnership, and one is the OHG, that's a general partnership. There are other forms of corporations or partnerships which I have not mentioned here because actually they're not relevant in practice for foreign investors. Let's start with a brief look.
Maybe Sven, I can add, because I have in Eastern Europe, I have had this discussion. Can you go one slide back?
Sure.
Sven. We had a lot of some discussions recently in Bulgaria, because in Bulgaria the main form of corporation is the share company, which is the Aktiengesellschaft, the AG. In Germany, the main corporate form is the GmbH by far, and the AG is really an exceptional rare breed in Germany for very large corporations.
Yeah, thank you, Matthias. I'll come to that when I explain the various forms. This was just a brief overview, but I'll come to that. Let's start with a branch office. What is a branch office? A branch office is a permanent establishment. It has its own leadership, its own assets, its own accounting, but it has no own legal personality. yet it has to be registered with the commercial register. And not very many foreign investors choose a branch office for their activities in Germany. The reason is that establishing a legal entity in Germany and operating with a proper legal entity in Germany creates much more trust for the contractual partners. So you don't see a branch office that often. On the other hand, we have corporations that you can establish in Germany. Corporations, whether it's a GmbH or a stock corporations, have one or more shareholders. There's generally no personal liability for the shareholders. Rather, the liability is restricted to the assets of the corporation. And as already mentioned, the major types are the GmbH and the AG. Now, the establishment of a corporation is a rather formal process in Germany. It needs to be notarized, and also the articles of association of the corporation need to be notarized. What does that mean, notarization? It means that representatives of the shareholder must be physically present at the notary's office, or the notary may come to you here in Germany. That's not a problem, but there needs to be physical presence with the notary, and then the notary will read out aloud the entire document of establishing the company and the articles of association. That's a concept which is alien to many jurisdictions. If I recall correctly, Estonia does have some similarities to Germany. So you might be familiar with that in Estonia, but we see a lot of irritation from people from other jurisdictions.
It's copy pasted. Corporate
yes.
legislation was 20 years ago. Yeah.
Okay. Now, foreign investors typically don't come here to Germany in person, but they rather issue a power of attorney to us as their attorneys for the establishment of a company. That saves time and money. They don't need to travel here. We can do it for them. So that's the usual way. It's the more convenient way to do it. The GmbH, a limited liability company, as Matthias said, it's by far the most common type of legal entity that you find here in Germany. Approximately 80% of all companies registered with a commercial register are GmbHs. And as Matthias mentioned, the Bulgaria example, there are jurisdictions where you don't think a GmbH is the proper form of entity. Well, in Germany, it definitely is. A GmbH has a minimum share capital of 25,000 euros, of which half has to be paid up initially. It is managed and legally represented by one or more managing directors. If there are more than 500 employees, it has a mandatory supervisory board, but that is not that common. I mean, usually you have companies that have much less employees, so you don't have to bother with a supervisory board. The shareholders are entitled to give binding instructions to the managing directors. That's a great advantage for steering the company. And this applies to all kinds of instructions, not only to strategic or fundamental issues, but theoretically, the shareholder could tell the managing directors, you have to buy a pencil. You can pin it down as much as you like, as long as it's a legal instruction. You can directly instruct the managing directors to do the things you want them to do as a shareholder. The UG. The UG is a special form of GmbH. It has existed since 2008 only. It's been the German legislator's reply to other legal entities abroad with low capital requirements, because the minimum share capital of a UG is only €1. But there is a special rule for the profit distribution. 25% of the annual profits have to be accumulated and may not be distributed until the share capital reaches the 25,000 euros, and then it becomes a normal GmbH, so to say. We don't advise our clients to establish a UG. A UG does have a bad reputation due to its low capital requirements. When you see a UG, you are particularly careful because basically you think that the shareholders and the company do not have money. The shareholders were not even able to raise 25,000 euros as a typical mindset. So we advise our clients to take a UG, to take a GmbH, a proper GmbH, and not a UG to establish here in Germany. That has a much better reputation. The AG is a stock corporation, as already said. Its minimum share capital is twice the amount as for the GmbH, namely 50,000, but only 25% of this amount has to be paid up initially. Like the GmbH, it is managed and legally represented by one or more directors, but unlike the GmbH, it has a mandatory supervisory board, and the shareholders may not give binding instructions to the board of directors. That means that the directors are much more independent legally in the AG compared to the GmbH. And a further disadvantage is that the formal requirements for the organization and structure of the AG are much stricter compared to the GmbH. The AG is the common legal form for publicly listed companies because that's a requirement. You cannot list a GmbH on the stock exchange. It must be an AG. Otherwise, it is rather uncommon because of its inflexible structure, because of the formalities. It's much more expensive in the ongoing administration. And that means that only about 0.2% of all companies registered in Germany are stock corporations, are AGs. And usually they're not of great interest for foreign investors as a company to be established. Usually the foreign investor takes the GmbH, as already said. Now, in contrast to corporations, there are partnerships. Partnerships, unlike the corporations, which can have one shareholder, partnerships require at least two partners. And this requirement often makes it unattractive for foreign investors to establish a partnership. They want a 100% subsidiary, usually. Well, there are, however, some advantages to partnerships, and that's that the partnership capital may be determined without restrictions. There's no minimum capital. A very important point, and I think Annette will touch upon that later on, is that partnerships are transparent for tax purposes. That's not the case, of course, for corporations. If you want to establish a partnership, there's no requirement for notarization. There's not even a requirement for having a written partnership agreement. It could be an oral one. Of course, it's sensible to have one in writing, but there's no such legal requirement. And there is a high degree of flexibility for the internal structure and organization of a partnership. The form of partnership which you see most is the so-called KG, a limited liability partnership. It has at least one partner with unlimited liability, that's the general partner, and at least one partner with limited liability. It is managed and legally represented by the general partners. Typically, you see only one general partner because you don't want to maximize the personal liability unnecessarily. But the partners with limited liability are not allowed to participate in the management unless this is stipulated differently in the partnership agreement. And one particular form of KG, which you in practice encounter quite often, is the so-called GmbH and Co. KG. It's a KG where the general partner is not a natural person, but a GmbH. The OHG, on the other hand, the general partnership, you will probably not encounter that often because it is a partnership in which all partners are jointly and severally liable. It is managed and legally represented by all partners, and it is typically not of great interest to foreign investors to establish such a company. You don't want personal liability. You don't want other partners to interfere, typically. What is required for all the entities I mentioned so far is the registration in the so-called commercial register. All branch offices of a foreign legal entity, as well as all legal entities doing business here in Germany, have to be registered there. And it's a very formal process, expected to be cumbersome. You will need a certified, notarially certified application for the registration. You will need to bring certified and apostilled documents, typically a register extract from the home country of the shareholder. It's a lot of formalities. And before a corporation can be registered, you have to bring proof of payment of the share capital. The typical bottleneck for that, again, then, is opening up a bank account here in Germany in which you pay in that share capital. German banks have tightened their KYC requirements very much in the recent years. Many of them are even reluctant to open up a bank account for, say, GmbH with a foreign investor as a shareholder. So it is a process which takes several weeks, several months even sometimes. I may say, however, that we have succeeded in getting all our clients registered, and eventually they succeeded in getting a bank account, but it's troublesome. In practice, it's really troublesome. So you should play well ahead of time if you want to establish a company here in Germany, and not expect to have it up and running next week, so to say. Starting operations here in Germany without a registered company is not a good idea, because if you're not registered, then there's a personal liability of the managing directors that act for the company in that case, and you don't want that, or the managing directors don't want that. Another type of register is the so-called trade register. Businesses generally need to be notified to the local trade registers. It's usually a formality because rarely permits are necessary. Only for certain businesses, such as you see here, financial services, real estate brokers, craftsmen, hospitals. There are others, but for the large portion of businesses, it's just a notification, a form that you submit that is relatively easy. So that's nothing to worry about in substance unless you need a permit. One more register, the so-called transparency register, or in other jurisdictions also called the UBO register. All German legal entities have to notify their beneficial owners to the transparency register. This does not apply to the branch offices because they are not legal entities. And who is the beneficial owner? It is generally a natural person holding more than 25% of the shares or the partnership interests, or holding more than 25% of the voting rights of that entity. That's the beneficial owner. If there is no such person, we do have so-called fictitious beneficial owners, and that's the legal representatives of the legal entity. So in any case, there is a beneficial owner to be reported to the register. In summary, we can say, while a foreign investor has the choice of opening up either a branch office or establishing a new legal entity in Germany, meaning a corporation or a partnership, almost all investors choose to establish a GmbH. And when you do that, you should expect the establishment to take several weeks or months in practice. It's not just a few clicks, but rather a very formal process. And with that, I would conclude my remarks, and I'm happy to take any questions if there are questions.
Dear Oswald, thank you very much for your presentation. I for sure have a couple of them.
Yes.
But let me first ask from the audience if they have. So please write them in any language you prefer. I will translate them. And since there is no questions, I will start asking from myself, based on our experience of working for and with the clients in Germany and establishment of some bodies entities there. So let's start from the end. You told about the register of the UBOs, and UBOs should be registered in the registry. The question, whether this registry is open for the public. Like in Estonia, for instance. In Estonia, anyone may enter the registry and see who the beneficial owner is.
It is not that easy. You can only do that if you have a particular interest. But there have been some back and forth movements in the past. It was open. First it was not, then it was open, and then this was taken back. So you cannot just easily check who that is.
Okay. Another question: recognition of trust services, recognition of trusts in Germany. Whether they are recognized, and this question is related to the bank account opening, because usually it's
very difficult.
Yes, it's suggested to appoint any local, let's say, representative director in order for the bank account to be opened, but who is in practice the trustee. So how it's legal in Germany, whether trusts are recognized, and how does it work in practice?
We don't have the legal figure of a trust here in Germany. Of course, there are trusts in other jurisdictions, and if you have a trust in the chain of beneficial owners, so to say, it makes things a lot more difficult, because the banks say, "Hey, this is something dirty, something fishy. We don't like that at all." So I think in practice you will have trouble getting a bank account opened, but you may find a bank doing that. But it certainly makes things much more difficult.
Okay, then back to the bank account opening. So even for 1 year share capital payment, it's also necessary to open the bank account, and this 1 euro should be paid on the bank account, and the bank certificate confirming that should be presented to the company's registry. Is it so?
Yes, that is so, because the notary will not submit the application unless the notary has received proof that the share capital has been paid in. The managing directors need to assure that the share capital has been paid in, and the notary will only submit that assurance with the application when that has happened, and he has proof of that.
Okay, and should be paid into the German bank account.
Yes.
Okay.
In practice, yes.
Okay. Because just for example, here we may pay it through any payment institution account, which has been recognized by the company's registry of BICE or something like that.
No.
Okay.
We don't have things like that.
Yeah. Another question for the partnerships, and especially for limited liability partnerships, which, by my personal opinion, looks more attractive. Whether foreign partners, 100% foreign partners, are allowed.
You are allowed to, that's not a problem at all. You are allowed to establish a partnership as a foreign investor. It can be 100% foreign.
Okay,
ownership.
because taking into consideration the problems with the bank account opening, and in case if it's you need to do the registration, so it looks like the branch or permanent establishment registration could be better, and the partnership registration could be a better solution, because you don't need to pay the capital and to face this problem with the bank account opening. And the last question from my side, your personal opinion from the management, from accounting and the reporting point of view, what is better to establish the permanent establishment if it's arise in case of some, I don't know, or if you see that it will arise in the course of some building or construction site, or to establish a local company, from management reporting point of view?
You usually establish a branch office only if it's a low-key business that you have in Germany. If you have larger operations, then you take your own company. But if it's very low-key and you think we don't need a proper entity for that, and for the market we don't need a proper entity, then you could take a branch office. Now, management reporting, I'm not quite sure what you mean by that.
Yes, sorry, I mean that for instance, in our case, we do recommend always to set up, if it's possible, a subsidiary or a local entity, because in case of the branch or permanent establishment, it's from Estonian taxation point of view, it's more difficult to manage the taxation and the payment of taxation, as here we don't have the corporate tax. And in case if there would be a branch established here which also do not pay taxes, but then after the financial year, next financial year, the taxes should be paid in the parent, not the parent, but the head office company jurisdiction. And then when this permanent establishment will be cancelled here, in this case, the assets or money earned here will be transferred to jurisdiction, and there will be also the payment, because we have the cash method taxation system here, will also be taxed in Estonia. So that's why I'm asking from our point of view.
Annette,
yeah,
is that a problem that you have encountered in that situation?
No, I think we will wait for the presentation about taxation, and that this is a specific question. I'm very sorry. I see one question in Ukraine. I will try to translate it right now. Parallel. Sorry, just a second. And yes, and I will put it. Sorry for the mechanical translation made by Google. But let's first I will put it here in chat, and then we'll So for the bank, the UBOs of GmbH is only personally in the transparent register, or can they be? Yeah. Okay. Yes. So the question seems to be whether the bank rely or believe or trust the information regarding the UBOs filed with the company's registry, or they usually do their own personal search to find whether the information filed in the company's register differs from information they disclosed somehow.
The banks typically do their own research as well. They have big departments nowadays, because the banks have been burned. They have been in trouble for money laundering cases, and they want to avoid getting in the focus for that as well. So they have their own research departments that do that centrally. And actually, we know that certain banks charge 4-digit or even 5-digit euro amounts for doing their own research, and they put that money on the client. If you want to open the account with us, you have to pay that to us.
Okay.
So they have their own research departments. They check that, and if anything is not does not seem to be proper, they ask questions. They want to see documents, and they want to clarify that.
Okay, and information, and if the information they disclosed will differ from the information filed with the company's registry, that for sure will make the problem for
Yes, of course, that's the problem.
applicants.
Yeah.
Okay. So any other questions, dear participants? Okay, if you would have something additionally to ask, you may also write it here, and we will do it, and we'll ask the questions at the end of the meeting. So thank you very much, Oswald. And
yeah, Gerrit will be next. Gerrit,
Yeah.
if you could take over, please.
Yes.
Thank you so much.
Hello.
Switching out.
Let me put on my glasses and take over the presentation. My name is Gerrit Widow. I'm an employment law partner here in the Hamburg office of Crow, and I'm a certified specialist in employment law, which covers social security aspects as well. And we are mainly advising employers on how to deal with employments, how to employ employees, and in the worst case, how to get rid of them as well. So I have approximately 10 minutes and 7 slides to bring you a little up to speed on the basics of German employment law. And up front, it's not as bad. So if you know how to circumvent problems, it's quite easy to employ employees in Germany. So a little bit in contradiction of what Sven said before, from an employment law perspective, you're not required to have a legal entity here in Germany to employ employees. So we have a lot of clients who simply start to dip a foot in the water and want to sell something and start to hire salespeople and so on. To do so, you don't need a German legal entity from the get-go. It has it is a good idea and it has advantages, but generally we have a lot of clients who simply run their business through an American LLP, an UK limited, or other legal entities. It is quite easy if you're coming from the European Union, of course, but it is a good option to start if you don't want to go completely into the legal entity right now. The only problem later on, you might have to transfer people to these legal entities. Nevertheless, even if you don't have a German legal entity, you will have to have a company number. And that's important to do payroll, which means as an employer, you have certain obligations to do payroll. That it means you have to deduct social insurance payments, and you have to forward them to the relevant authorities. This is done as a one-stop shop for your health insurance usually, and to do so, you have to do a registration, which is done online, usually by your payroll provider. Our colleagues do so all the time. So in the end, you have a company number here. This is not a tax number, by the way. So, but a little paperwork has to be done. Just to know, German has a very qualified social insurance system. Out of a lot of social insurances, costs are almost equally shared between employees and employer. Overall, in 26, these are 43.2% of the gross wage, meaning the employer's costs are in the end 121.6% of the agreed gross wage. If you want to employ an employee, you have to have an employment contract. This doesn't have to be in writing right now. Nevertheless, we recommend to do so because there is a law in place in Germany that you have to present the essential terms of the in writing or text form at the latest on the first day of work. If you don't do that as an employer, you might have a risk of official fines of up to 2,000 euros per case. But as this is a rather new law, we never had a client to have these official fines, but you should be aware of that risk. So if you start, it is always a good idea to draft a bilingual German, likely English employment contract, add all the necessary wording. There is a long list of information that you have to provide by law. And then if you have an up-to-date draft, sign it from the employer side and let it countersign from the employee, and let him come or her confirm that you received it and you're done. So one additional aspect, and that's why we usually recommend to do it in writing, old-fashioned way. If you have agreed on a fixed term contract, the fixed term is only valid if it's done in writing. Same applies for training contracts with trainees. And on the other side, if you want to get rid of an employee later, termination letters, termination agreements, and so on will need handwritten signatures, meaning digital signature or fax or anything else is not sufficient. Just to inform you, the current minimum gross wage is 13.90 euros per hour. It is going to increase next year on 1st of January to 14.6 euros. As mentioned, when you hire employees, you usually sign the employment contract a few days, weeks, or months before. And then it's a good idea to get started with getting payroll ready. This can be done, you can do that yourself, but it's usual to ask somebody to take over payroll services. And then you have to collect a lot of information from the employee, social insurance number, name of the health insurance, check if he has a visa and a work permit, and so on. And then with these information, your payroll does a digital registration with the health insurance and sets everything up to pay social insurance contributions to the health insurance on behalf of you as for your part, and on behalf of the employee on his part, because that's deducted from the gross salary before paying out the net. There's the need that you should start doing it 6 weeks after the employment starts at the latest. Usually when you're planning a little ahead, that is not a problem. Nevertheless, it is crucial to have somebody that is specialized in payroll, because there are a lot of things that you, when you're coming from abroad, would likely miss if you simply start doing it yourself. Next important question is, who am I able to employ? It's likely known that if it's EU citizen, there's no problem with regard to residence permit and work permit. All EU citizens are treated like German citizens. So if your employee is a Spanish national, that's not a problem to employ him in Germany. For all others, it's a little more tricky. You need a residence and a work permit, and that needs to be applied for in advance, and that takes between 1 and 6 months, depending. There are regulations that make it a little easier for skilled workers. And if you have a specific academic background, or if you in an area where workforce is desperately needed, you can apply for the so-called EU Blue Card. It is a lot of work, so it's better to start early. One workaround option you have, if you want to start earlier, you can send some employees to Germany for a certain period for business trips. Be aware that they are not doing actual work, but they're preparing work and so on. And as we have a lot of participants from Ukraine, the good news is if they are under temporary protection and they are in Germany as a refugee, they have a limited residence permit and as well a work permit that is currently extended to 4th of March 27. So all Ukrainian nationals who are in Germany don't need an additional work permit if they are under the Section 24 of the German Residence Act as a refugee in Germany. As mentioned, Germany is known for rather strict employment laws. They are all intending to protect employee rights. So it's a common myth that in Germany it's hard to get rid of employees. That is not completely correct. So yes, the Dismissal Protection Act is purely intention is to make it more difficult to dismiss people. But first of all, it is only applicable to companies or operations who employ regularly more than 10 employees. And on the individual part of the applicability after 6 months of service. This means that in the first 6 months, you can check if your employee is a fit, if his performance is right, and if not, you have usually a probationary period with a shorter notice period of 2 weeks, and you don't need a reason to terminate the employment if you're not satisfied. If you have that in mind, our recommendation usually is use this option wisely and check after a few months if the employment is going as you hoped. Afterwards, it's becoming a little more difficult. Then you need one of 3 reasons to terminate employment. Personal reasons, which can be separate thing, most common, long-term illness, you lose a work permit, or in case you are a driver, you lose your driving license for a certain amount of time, and so on and so on. The other option is a termination because of behavioral reasons. Often, if you have somebody doing stuff in the operations that are a criminal offense, usually you have the opportunity to terminate the employment without notice with immediate effect. And all other things are subject to extensive case law. As a general rule, you need to have at least one written warning about such a behavior. If the behavior is severe, usually you don't need a written warning. And the most common reason for dismissal are urgent operational reasons. That covers, for example, persistent lack of orders, plant closing, restructuring, you're choosing to restructure your operation and go in another direction and so on. And then you have to consider social selection, which basically means first in, first out. So the youngest with the lower periods of service and without kids are the ones to go first. And you have to check if there are other vacancies that are comparable and could be done instead. So if you have one of these reasons, and if you terminate the employment by giving notice, first of all, the employment ends at the end of the notice period only. This means it's not the case that somebody receives the termination letter and leaves the office or the operation on the same day. Usually there is a lot of time to do some work, and they are obliged to do the work until the end of the notice period, and you are of course obliged to pay the salary until the end of the notice period. You can of course send them or release them from work, deducting vacation, but generally it's a little different, like for example in the USA or in the UK. Another thing is that in Germany it's not the end of the world if you are sued in this case. I guess in 50–60% of the cases you're getting sued in front of a German labor court. And in the worst case, if the German labor courts decides that the termination is not valid, your employment continues. The court does not decide that you have to pay a severance or anything else. If the termination is invalid, the employment continues. You have to employ the employee as agreed, retrospectively pay salary, and maybe better luck next time. That's the reason why approximately 90% or 92% of the cases are ending up in a settlement in front of court sooner or later. It's all depending on the legal risk and money, of course. But we're well experienced in these cases. That's basically our job. The best advice I can give you is know the law, be prepared, and have some money ready. So another thing in Germany is a works council. This can be established if you employ at least 5 employees. And from these 5 employees, at least 3 have to be eligible for election. Eligible to vote are any employees who are above 18 years. And vote can anybody over 16 years. Such a works council has extensive co-determination rights. This means he has to be informed and participate in this decision to hire and fire people. He has to be informed accordingly in the decision to promote, demote employees, and so on. He has a lot of rights to monitor laws and collective agreements. This can be a little problematic for employers who are not familiar with that co-determination system. Nevertheless, there's nothing you can do about it, because if you do, or if you obstruct the work of a works council or the election of a works council, this can be a criminal offense and be punished by imprisonment of up to 1 year or a fine. So they are not fooling around in this regard. The good news are that there's no legal obligation to elect a works council, and the majority of smaller businesses, even if they employ 100 employees, don't have a works council. Yeah? In your case, if you're new in Germany and starting from scratch, it is rather unlikely that employees will establish a works council immediately or in the first years. So another thing that you need to be aware of is collective labor agreements, CLAs. Germany has a landscape of a lot of different CLAs. You need to understand that they're not applying from the get-go. You either have to agree to them with the union, or you have to be a member of the employers association. And the third option is they are declared generally binding for your area of business. This is especially the case in some in construction and related sectors, roofing, painting, electrical work, cleaning, and so on. So in case you have the plans to start a business in one of these areas, you should know what is the minimum wage, what are the binding CLAs. Nevertheless, just starting in Germany doesn't lead to the applicability of a CLA. And again, for small businesses, it's rather uncommon. So it's as well not the end of the world. The most important thing is you need to be aware of these aspects, of these problems, and know how to circumvent them or how to deal with them. So that's it from my perspective. And before I give over to my colleague Annette Groschke, who will inform you about tax aspects, are there any questions?
Yes, thank you so much. I also already placed one question. You may see it there. Yes, because I see it's pretty difficult. You need to be very careful employing the locals, anybody locals. So the question is, maybe it's possible in some cases, and how do authorities react on the contracts with self-employed persons, so professional contract, instead of making the employment contract, in order to avoid the things you were talking last 10 minutes?
Yeah, you got to be careful, because if you have a false self-employment, you're in fact having an employment, and you will have to retroactively pay social insurance, taxes, and so on. And that could lead, in the worst case, to criminal offenses for your managing director in Germany. So there are options to work with self-employed employees. They don't the main thing is, if you're working with somebody who does some services alone and just for you, and he's more or less integrated in your operation, it's rather likely that a court or the authorities will see this as an employment, because he's not just economically, but in other areas as well, dependent from you. So there are options, but they are limited. And if you simply have somebody run your business as self-employed service, it is usually a high risk that at a certain point there will be an audit, somebody will check that in detail, and you will get in trouble regarding fines, retroactive payment of social insurance, and in the worst case, even criminal offenses. So it is a little too difficult to explain all the options, but as a rule of thumb, the more the self-employed is integrated in your business, the more it's likely it's an employment. If they're doing some specific services and just them, and they have other clients and they have a running business, that might look different. But to start with, I would recommend use employees from the get-go, because it is, especially if you're under 10 employees, it is safer and you're getting rid of them as well because you don't have protection against dismissal. So the main reason to work with self-employed usually was to avoid protection against dismissal. But if you're under 10 or at 10 employees maximum, this reason doesn't count because you don't have protection.
Okay, one more question. For sure,
I think maybe I can one comment on this.
Yes, Matthias. Yes, sir.
Again, because
yes,
I think Gerrit outlined it very clearly. But you are, of course, if you, I just take an example from which may work is, for example, if you want to set up a sales organization in Germany and say, okay, there are agencies that support you in selling work. But as Gerrit said, it should be an agency that has several contractors working for them, just as a guideline. And it should be an agency that more or less gets a general guideline on how to do the sales work, but then decide on the operational issues on their own. So they have more or less a target that they have to achieve. They're independent. They're working largely independent on that. So that has to be checked. Then is it really a contractor or is it a self-employed person that will be let's say allocated to the employing firm?
Okay. Yeah. Thanks so much.
Just to clarify,
a couple of questions more. For sure, the conditions for foreign employees which work in Germany temporarily, they also should be the same as for German employees, as for local employees. The question is more practical. Maybe it's pretty usual that from Eastern European countries, the many builders, the many people working on the construction sites are working temporarily. So how and which way? I think that in some cases the salaries paid to them they are lower than even the 14 point, I'm sorry, do not remember, 7 euros. So how it is, and is it checked somehow in Germany? I mean, how the employment of the foreign employees working temporarily are paid?
The thing is, you are talking about somebody sending over employees to do a service in Germany.
Yes, exactly.
Nevertheless, if they are dispatched to Germany, there are strict rules, especially in the construction industry, that have minimum wages, especially for these cases. So in real life, that might go well for a while, but usually, especially in construction, there are checks and audits on the ground all the time. So there is a specific law and specific CLAs that are in place, the Posting of Workers Act and so on in Germany. So there are some opportunities to work in Germany temporarily on that basis, but certain minimum wages and minimum working conditions have to be applied for these dispatched employees as well.
Thank you so much.
And to be honest, construction is the most checked area because of these. So it's rather likely that you start and after a few weeks, especially if you work on huge construction sites, there will be an audit and there will be teams on the ground asking your dispatched employees about their salary, about their conditions, and that will backfire. So if you plan to do so, plan ahead, get familiar with these, with the Posting of Workers Act in Germany and the minimum conditions applicable, because that might lead to criminal offenses. They're not fooling around in this regard, especially in construction.
And these unannounced inspections really have been ramped up in the recent years. I think it's done by the customs authority, and so it's a high risk that this will be verified and detected.
Yeah, and you got to be aware of something. Construction is, of course, paid better in Germany because of the higher prices in Germany. So we have a lot of clients who, of course, send employees to Germany and work in Germany temporarily. But they're paying quite more than minimum wages in Germany as well, and they still make a few euros on these projects. So only again, this could only work from a pragmatic perspective for a few weeks. In all other cases, I would be very careful.
Thank you so much. Dear audience, any additional questions before we'll give a stage to another speaker? Okay, thank you so much.
You're welcome.
And yeah, and stage is yours.
Okay, I take over now. Okay, so thank you very much. My name is Annette Groschke. I'm a tax partner at Crow Merle Hub Luther here in Germany and tax advisor with more than 20 years of professional experience in international tax matters. Together with my colleague, I'm responsible for our service line, international tax and transfer pricing. Our focus is on supporting international groups in navigating through the tax implication of cross-border structures and transfer pricing. And so I'm very pleased that I can guide you today through the key tax aspects that matter when entering the German market. I hope you can see my presentation now. Yeah, okay. So from a tax experience, when we see a market entry, we think it's often not a clear-cut decision, but rather many times a rather evolving process. Many business starts by supplying goods or services directly from abroad to Germany in step one. Over time, however, the business may expand, the activities may expand, perhaps through local staff involvement in Germany, customer visits, or the use of local facilities, and the business may perhaps slide into a permanent establishment, and sometimes that might be dangerous without even noticing it. And in the second step, perhaps as operations grow, companies, as Sven described at the beginning, companies often decide to set up a full-fledged German entity to stabilize the business in Germany. That's often we see this process. And from a tax perspective, it's important to know that each stage of this development, from a simple cross-border supply to a permanent establishment to an incorporation of a company in Germany, comes with special tax consequences, and you should be aware of these aspects. We therefore have here collected some selected tax issues. I mean, the general question is always, what triggers taxation in Germany? First of all, then the question is, when does a permanent establishment arise? When are the requirements fulfilled? And what are the tax implications if we set up a German company in the second step? And because it's so crucial in our experience in cross-border group structures, I like also to have a look with you to transfer pricing issues in Germany. If we have considered this at a company level, I would then like to move on, and after this part, we will have consider some key aspects. What happens when employees are assigned from abroad to work in Germany? What are then the payroll tax implications? That's then the second step. So this is a tax plan for today, and I then would like to start with the permanent establishments. I mean, you probably know a PE, permanent establishment, essentially represents a taxable presence in Germany, and it can arise in several different ways. we have here a slide where we show the main types of permanent establishments under German tax law. I mean, the most common form is a facility PE. You see it here on the left side of the slide. It arises when there is a fixed business premises in Germany that the company can use for carrying out its own business operations, so perhaps an office or something like this. And this premises must be, that's the next requirement, at the disposal of at the company's disposal. And it must have a certain degree of permanence. So these are the requirements. Due to this requirement of the company's disposal, it is important to know that, for instance, the home office of an employee in Germany, according to German law, does normally not result in or not lead to a permanent establishment in Germany. Most double taxation treaties, by the way, say that purely auxiliary activities such as storage, for instance, or just the procurement of information do not trigger a PE, and that's therefore same in Germany. So the second category of permanent establishment is assembly PE. Under German domestic law, an installation work or construction site becomes a PE if it exists for more than 6 months. However, most of our German treaties, double taxation treaties with other countries, extend this threshold so that a PE may only arise after 12 months. That depends a little bit on the treaty. And third, and that's also very important in practice, is representative PE. This is triggered when you have a person in Germany that habitually acts on behalf of your company, your foreign company. If this person has the authority to conclude or substantially negotiate contracts, it's normally considered as a representative PE. We say here if the authority is so far that he can conclude or prepare a contract ready for signature, then the requirements for a representative establishment are normally fulfilled. You see here the key requirements are the long-term nature and the binding authority of a representative. So this issue here might a bit of danger. You need to be aware that you do not slide and this representative establishment may be owned without noticing it. Yeah, and finally, just only short to mention is the management PE. This applies when the day-to-day management decisions of a company are effectively carried out in Germany. So what does it mean in practice? It means a PE can often trigger when a foreign company conducts business activities in Germany through a physical location or employs staff who carry out substantive operational tasks here. And that is why, from our experience, we think monitoring the business development is so important, because what may start as an occasional activity can evolve over time into a taxable footprint, and this can happen much sooner as sometimes expected. So what are then the consequences? If there is a PE, let's consider here a really very simple example. Let's consider we have a company in the Ukraine who establish a PE in Germany, and the question is what happens here tax-wise. I mean, it's clear the tax consequences is that the business becomes subject of limited tax liability in Germany. This means all income attributable to the PE is taxable here. The profits attributable to the PE must be determined in accordance with the so-called authorized OECD approach. This means that a PE is treated as a separate and independent enterprise. This means all income, all expenses that belongs to the business carried out in the PE is subject of taxation in Germany. Yeah, and beyond this tax liability itself, PE triggers, of course, administration obligations in Germany. Generally, the PE must comply with German bookkeeping and accounting rules. It needs to maintain proper records, file relevant German tax returns. Please consider also possible VAT registrations and regular VAT compliance if the PE performs taxable supplies within Germany. Exactly. So it is important to remember that this obligation generally apply already from the moment the PE is created. And yeah, this is why we think it is so important to early identify and continuous monitor the development. It is essential to avoid retroactive assessments because this can cause late filing penalties and other compliance risks. So the next question is, what happens once a company decides to move beyond a PE and establish a formal presence in Germany? And at this point, the choice of legal form becomes highly relevant also from a tax perspective. Sven has at the beginning has already described these legal forms. But please be aware that different legal forms follow also different tax principles in Germany. And these principles determine how profits are taxed, whether taxation takes place at the level of the company or at the level of the shareholders, and how efficient repatriation of profits can be achieved. On this slide here, you can see the main legal forms under German law, divided into partnerships on the left side and corporations on the other side. And it is very important to know that partnerships, including the common GmbH and KKG, follow what we call the principle of transparency. In contrast, corporations, in particular here the GmbH, operate under the principle of separation, and this means the company is fully separate legal and tax entity. So now let's look how this works in practice. Starting here with the partnerships on the left side. Under the transparency principle, the partnership generally is not the taxpayer for income tax purposes. Instead, the profits of the business flow directly through to the partners, and the partners are taxed at their respective tax rates. In other words, the partnership is used for profit determination, but the actual taxation takes place at the partner level. This is important. And the tax burden, therefore, depends entirely who is the partner. Is the partner a corporation? Corporate income tax applies. If a partner is an individual, personal income tax applies. Regarding the tax place rates, I will show you in a minute. On the right side, you see the corporations. In contrast, they follow the separation principle in Germany. The company is a separate taxable entity. This means it pays corporate income tax and trade tax on its own profits, and only when the profits are distributed to the shareholder, then on a second level, the shareholder becomes subject of taxation in Germany. As a general rule, one can say partnerships can be more efficient in some cases, tax efficient in some cases, but they require careful analysis because the partners themselves become subject of taxation in Germany, and the legal framework of partnerships in Germany from a tax perspective is very, very complex and complicated. Therefore, many foreign investors actually choose the corporate route, usually a GmbH, because this tax system is more predictable and the corporate structure is internationally well known. As Sven already said, the GmbH is also from a tax perspective, therefore far the most commonly chosen legal form for foreign investors entering the German market. And because of this practical relevance in the following, we will focus on the GmbH and consider the tax rates. Corporations in Germany are subject to three main components of taxation. This is the first, corporate income tax, second, solidarity surcharge, and third, what we call trade tax. The corporate income tax is levied at a flat rate of 15%, And on top of this, we have the solidarity surcharge of 5.5%. It applies, but only on the corporate tax amount. So the corporate income tax amount is the tax base for the solidarity surcharge, which leads in an effective tax burden for these two together of 15.825%. And additionally, we have the trade tax in Germany. Each GmbH or corporation is subject to trade tax. The trade tax varies by the municipality, so the city where the company has its German seat. But on average, one can say trade tax is something around 15%. And this comes then in the end altogether to an overall tax burden in Germany, roughly about 30%. Looking ahead, there is planned to reduce the corporate income tax rate to become a little bit more attractive in Germany from a tax perspective. So the corporate income tax rate will gradually decrease starting in 2028 with a long-term goal of reaching 10% in 2032. So, but as mentioned, shareholders of corporations become taxable only if dividends are actually distributed, and this leads us to the question, what happens at the shareholder level as soon as dividends are distributed? Yeah, and in this respect, it is crucial to understand that tax on such dividends is generally withheld and paid directly by the distributing company in form of a withholding tax. In addition to dividends, we see this withholding tax in Germany also in case of payments for interest or royalties to non-resident. But here, given the limited of time, I will focus here only on withholding tax on dividends. And here we can say that the standard withholding tax, according to our domestic German law, is 25%. Plus solidarity surcharge, which results then in 26.375%. However, and that's important, most double taxation treaties reduce this burden significantly, typically to rates between 5 and 15%, a little bit depending on the shareholder levels. And for EU parent company holding at least 10% in the German corporations, the EU parent subsidiary directive generally allows a full exemption from withholding tax. However, this is very important for you. Please keep in mind that this treaty reduced rates does not apply automatically. The taxpayer needs to apply for it. And in practice, this process can be quite challenging because it often contains some hidden pitfalls you should be aware of. I have illustrated this here for the process of dividends. It is important to know that Germany applies very strict anti-abuse rules. So this means even if the treaty provides for a lower rate, the foreign shareholder must actually qualify for it, which requires, said in simple words, sufficient economic substance and genuine beneficial ownership. Only if you can prove this and meets the relevant requirements, you can apply then for a certificate of exemptions with the German tax authorities. And if the certificate is granted, the German companies, the GmbH, for instance, does not have to withhold tax on the dividend payments. Normally, this way is the preferred approach because it avoids cash flow disadvantages and lowers a little bit the administrative burden. However, if no exemption certificate is available at the time of payment, the German company then must withhold the full domestic tax, but in this case, the foreign shareholder can submit a refund application. Nevertheless, this procedure can take several months, and that's sometimes a little bit annoying. So before we move on, there's one topic we absolutely must address because it is so important in German tax audit, and this is transfer pricing. Currently, many cross-border transactions within an international enterprise group is really scrutinized during tax audits, and one can say insufficient transfer pricing documentation or inappropriate transfer pricing can really lead to substantial adjustment and penalties, and that's why I would like to make you aware of this. In the end, one can say transfer pricing is not only a technical detail, it's a core element of tax compliance, and that's why I would like to walk briefly through the main principles and documentation requirements in Germany. Let's again start with a very simple example. Let's imagine we have a company in the Ukraine that has a subsidiary in Germany, a GmbH, and delivers now supply, services, financing, something like this. Then transfer pricing is important. Transfer prices are the prices for the goods, the services, the financing, and other transactions between related companies. German transfer pricing rules generally follow the OECD guidelines you probably also know in your countries, and the central requirement is therefore always dealing with the arm's length principle. This means the prices agreed must be the same as the prices that would have been agreed between independent parties under comparable circumstances. In Germany, the tax authorities expect this analysis to be really well done, well documented, and consistently applied. We have here different transfer pricing documentation items. As common in international practice, Germany distinguishes between the CBC, the country-by-country report. You see it here on the left side. It is for really big, large groups with revenues about 750 million euros. In most cases, more important is the master file. The master file gives a broad overview about the group structure and the general transfer pricing structure within the group. It needs to be prepared if revenues exceeding of the German entities exceeding more than 100 million euro. And very important in practice is the local file that gives detailed information about the transfer pricing with regard to special transaction. It includes a factual description and proof and a description of the appropriateness of the transfer prices. It needs to be prepared if special thresholds are exceeded. In case of the supply of goods, the threshold is 6 million, and in case of services between related entities is 600,000 euro, the threshold. Initial documents as a master file, also the extraordinary business transaction documentation and a so-called transaction matrix needs to be filed in Germany within 30 days after the announcement of a tax audit. Local file must be submitted only upon further request. However, and that's important for me, the key takeaway for you should be TP documentation is very necessary and it should be ready before the audit starts, before later. It's normally too late to bring everything together. And here, one final remark on this topic, the documentation requirement should be taken serious because the sanctions for non-compliance can be significant. The range is from a reversal of the burden of proof to extended estimation powers for the tax authorities to really substantial penalties in case of late submission or non-compliance. and in a worst case scenario, there may also be criminal consequences. So this is important. So finally, before we close our tax issues, let me touch one final area that matters greatly to many international business. This is expat taxation. So when employees are posted to Germany. This topic is, from our experience, very important because payroll obligations apply immediately, and mistakes can create tax liabilities for both the employer and the employee. Therefore, on this side here, you can see the core framework for German taxation of employment income in the context of cross-border assignments and international employee secondments. The key starting point is always the question whether the employee posted to Germany is tax resident in Germany. If an employee is tax resident in Germany, for example, because he lives here or spends significant time in Germany, he becomes subject of unlimited tax liability. This means the worldwide income is taxable in Germany. If the Germany is not tax resident in Germany, they may still fall under the limited tax liability in Germany. And in this case, generally only the income that relates to the German work days or activities performed in Germany is taxable here. Because international assignments often lead to double taxation in the host country on the one side, in Germany, and on the home country on the other side, double taxation treaties play a really crucial role in practice. The good news is Germany has a very extensive network of double tax treaties. Currently, nearly 90 treaties are in place with a broad range of countries. And in many cross-border assignments, double taxation is based on this treaty, often avoided through the well-known 183-day rule. You probably know it or might know it. In simplified terms, this rule prevents Germany from taxing the German workdays if the employee keeps their center of vital interest abroad in his home country, the employee stays in Germany for fewer than 183 days, and the employer remains abroad, and finally there is no German permanent establishment that economically bears the salary. If these requirements are fulfilled, normally there is no payroll taxation in Germany, but please be aware that the German wage tax withholding may only be omitted if in advance a so-called exemption certificate has been applied. So moving then on to my last slide, it provides an overview of the German personal income tax rates and highlights several typical categories of work-related expenses. As you can see here, in Germany applies a progressive income tax rate from 14 to 45%. And in case of higher income employees, also the solidarity surcharge needs to be considered. If the employee is a member of a church, there might also be church tax applicable. On the other hand, we have several categories of expenses that can be reimbursed tax-free by the employer. This includes, for example, relocation expenses, travel costs to a special extent, home office allowances, training costs, things like this. And these allowances can reduce the overall tax burden and should be considered when structuring assignment package properly. So on this point, I would like to conclude the tax section and hope that the overview gives you a clearer and more practical understanding of key tax aspects in Germany. And I'm pleased to answer questions if there are any.
Thank you very much, Annette. I would like to ask audience to write questions, if any. I have for sure some questions from my side, and would like also to give some comments. The comment number one, the taxation issues and the questions, they are very it could be very complicated, and in case if you, being any foreigner, are starting some business activities in any country, especially in Germany, you have to be very careful in planning and in tax compliance. From our perspective and practice, what you were saying about the permanent establishments, we faced several times such a problem that any company which were planning to finish the building site, let's say it half a year, but it was due to some reasons, was extended for the period which exceeded 9 or 12-month period, which created the permanent establishment. And they were not paying any taxes on the employees' salaries, as they were expected the permanent establishment not to arise. They were intended and they needed to pay all the taxes in Germany retroactively or in some other jurisdiction. But those taxes has been paid already in their own jurisdiction. So there was double taxation with future problems to get those taxes paid back. And the same issue may arise in case if a German company will be recognized as an economical employer. So in case if it will not be considered just hired or rented out personnel, but the German authorities or any other country authorities may consider the local company which rented the employees economical employer, and in this case the situation could be similar. So all the taxes, they were needed to be paid in Germany, but they were paid before in their home jurisdiction. So this proper tax planning and very careful approach is very, very important in order to avoid double taxation at least, or as you and your colleagues mentioned it several times before, any criminal responsibility. Even. But I have some, we are already out of time and will be out of time, but I will ask just one question, try to focus on the partnership issue. Just a simple sample. Let's consider that a group of programmers, companies, natural persons from Ukraine and Estonia created the partnership in Germany in order to do local sales of the products. Mm-hmm. They do not have any management in Germany, or maybe some, let's say, manager to be a representative of this partnership in Germany. How, in this case, this income will be taxed in case if it will be considered, the payment will be considered the services and royalties. What would be the approach?
So what is the case? The sales? Is there sales activities in Germany? And
yes, partnership registered in Germany, having sales in Germany for local companies of programs of software.
Yeah.
The partners, all the partners are foreigners. Let's say Estonians, Ukrainians, legal and entities and natural persons. And those software could be considered whether services, one case, and the second case licensing, so the royalty. So would you please in a few words say how in this, what would be approach in this case, taxation approach of this partnership in Germany?
Yeah, okay, so we have the transparency system in Germany. And if there is a partnership, I imagine there's an office or something like this where the sales activities.
Let's say one person, one representative, yeah.
Yeah. So and there are services. So
yeah.
So the turnover is the income from the services. It belongs to this office. The income is taxable in Germany, and it is taxable on the basis of the income tax rates. If the partners are individuals.
But they are individuals which are foreigners. They are not tax resident. So So that means that it will be taxed as a corporation, not as a partnership.
No. If the partners are individuals,
Yes.
and we have a permanent establishment or partnership in Germany, it's the same, then each partner becomes subject of taxation in Germany, and it has to be taxed, or he or she has to be taxed with income tax rates, as shown here on the slide.
Okay, but whether the double tax treaty applies in this case, as okay, he becomes the taxpayer in Germany, but
right. Yeah, and the treaty says Germany is entitled to levy taxes because we have here a permanent establishment, and therefore the tax right is here in Germany, according to Article 7.
Let me write you maybe later on just to do other explanation. Just you need to understand. Let's not waste the time because again we're out of time. Thank you so much, dear audience. Any other questions to ask? No, thank you so much. Have a nice day, and let's go to the last presentation as far as I remember from the file I see. Thank you.
Yeah, great. Thank you. Then I may jump in. My name is Erik Dumke. I'm an audit partner with Crow in Hamburg for some 2 years now. Before that, I spent my professional career with Deloitte, PKF, and Grant Thornton. And it's my pleasure to give you a basic understanding of the financial reporting and audit requirements in Germany. I would focus on the legal forms of entities Sven already made you familiar with earlier. So looking on commercial partnerships or limited liability corporations, there's a legal requirement in Germany to maintain bookkeeping records. Those records have to be kept in German language. So if a group may consider to use a shared service center or something to have a centralized European accounting using another language, then you have to be prepared that the German authorities may insist on getting translated records for the German company. Not a surprise, the records have to be kept in euro, and the accounting data has to be stored in Germany. So if the relevant accounting database or even parts of it would be relocated or established in another EU country, you have to take care that German authorities always have access to this data. And if you even consider to establish the relevant data service outside the EU, it's inevitable to have a prior written consent of the German tax authorities to avoid any penalties and other legal action later on. The business year in Germany usually is the calendar year, but of course you could also opt for another reasonable 12-month period. In a couple of industries, that's quite common if you look in the chemical industry or tourism, where the end of December may not be a suitable balance sheet date. So that's up to you. But you always have to consider that the business year in Germany never may exceed 12 months. I know this from other legislations where for example, in cases of founding an entity or in merger cases, there are 15 or 18-month accounting periods, but this is not permitted in Germany. Looking on the requirements on preparing financial statements, it's important to consider the company's size. Considering time, I will speed up, not read out all of the amounts presented in the table down here. Basically, we have this sizes of companies in Germany: micro corporations, small corporations, and then the mid-sized and large corporations. As you can see, I think most important one is the mid-size, which would be in the range of more than 7.5 million euro of total assets, up to 25 million, and revenues of more than 50 million, but less than 50, and employs as an average headcount over the year of more than 50 and less than 250. This, I think, is the main step for changes in the requirements on financial statements, as I will show you on the next slide. And also, you may consider the threshold for groups of companies, which you find in the red-lined row here. So if a group of companies would make more than 50 million of revenue, or hold total assets of more than 25 million, or more, have more than 250 of headcount, there's also an obligation to prepare consolidated financial statements. What I would like to point out is that for qualifying for one of these sizes, the company's financials have to exceed 2 out of 3 of these criteria in 2 consecutive years. Doesn't have to be the same. So if, for example, in 2 years you exceed maybe total assets and revenue in the first year, and revenue and employees in the second year, then you would qualify for the next size level. What are the consequences out of this? Looking on the reporting, the micro corporations just have to prepare balance sheet and PL statement, both in a shortened form. So that would mean that certain balance sheet or PL items may be presented in an aggregated format. Small corporations also have to prepare notes to their financial statements, and mid-size and large corporations, in addition, have to prepare a management report. And yeah, looking on capital market orientated corporations, they would also have to prepare statements on cash flow and change in equity. As you can see, the size of the company would trigger an increasing reporting requirement. And I would just give you a brief idea on the management report, which I think is more or less the German specialty. The content necessarily would include, first of all, a description of the entity's business, to give a better understanding to the stakeholders what the company is doing. And then would give an overview on the macroeconomic and the industry business environment and development, to put a greater frame in understanding the financials. And this would be followed by explanations on the course of business in the year under report of the entity, and it would also give a detailed analysis of the financial position, which would mean a detailed analysis on balance sheet items, like equity ratio, changes in fixed assets, whatever may be relevant to the financial position. The same applies to the P&L items, like development of revenues, whatever, and to the cash flow of the company. These are the items of the management report, reflecting the past. And in addition, you have to give an assessment of the risks and opportunities relating to the future development of the entity's business, which would also include a forecast, which usually is based on the expected developments of certain KPIs, which are considered relevant for steering or managing the company. For example, the revenues, gross margin, EBIT, annual result, whatever. All this information together should put any interest party in forming a greater picture of the company and understanding the course of business. The management report also would be the place for giving explanation on, for example, going concern issues or restructuring needs of a company. Just a small excursion to the expected regulation resulting from the EU CSRD, which is the Corporate Sustainability Reporting Directive. This would apply to entities or groups of entities exceeding a total headcount of 1,450 million euro of revenue. Then you would have to set up a sustainability report, which have to be based on the European Sustainability Report Standards, which is the ESRS. And this sustainability report would form a part of the management report. This regulation will, in first time, have to be adopted in the business year 2027. So it's still some time to prepare, but nevertheless, it's an important piece of reporting entities should be prepared for. Yeah, finally, just a brief comment on reporting deadlines. The compilation of financial statements has to be performed within 6 months after balance sheet dates for small corporations and within 3 months for mid-size or large corporations. And the filing of the financials with the digital register in Germany has to be done not later than 12 months after the balance sheet date. I would just jump to a few other aspects which may be of interest for you as international investors. There are specific local GAAP rules, of course, for certain industries like financial services, looking on banks, insurances, investment trusts, whatever, for energy providers or hospitals. So there's a couple of specific GAAP rules which have to be considered then. And for the mandatory German financial statements, you have to consider that the application of IFRS is only admissible for group financial statements in Germany and not for standalone financials. And yeah, finally, just a few comments on the audit requirements in Germany. A statutory audit is required for the mid-sized and large corporations and also for mandatory group financial statements. And apart from that, there are a couple of special purpose financials. For example, if you're forming a company by a non-cash capital contribution, there are legal requirements to also have an audit in these cases. And just to finally point out, the audit opinion also has to be filed together with the financial statements to the public register. So that would mean unless the audit isn't closed, you are not in a position to publish a really complete set of financials to the public register. Yeah, I hope I speeded up enough to grab some time again. So I'm happy to answer your questions on any accounting or audit question you may have.
Thank you so much for your presentation. Dear audience, any questions regarding the filing of the reports? It seems to me that everybody are thinking that reporting and submitting of the and filing of the declarations is something of not so high importance that like taxes or something similar to that. So that's why there is no questions currently. And again, thank you all of you for your presentations made. I hope that if any questions from my side, as I noted before, will arise, you will find a time to answer them. and I do not know if it's been agreed. Maybe we will ask it from you, your allowance in writing, to publish this video in media, in our social networks. Thank you again, and wish you a nice and pleasant weekend, and all the best.
Yeah, thank you very much. It was a pleasure to us.
Thank you so much. Ladies and gentlemen, I don't see whether Dimitri is still with us. If not, if yes, maybe he will say something. Let me take a look. No, he already left the meeting. So, ladies and gentlemen, thank you very much. All the best, especially for Ukraine, this difficult and cold winter. Keep strong. We are with you. All the best. Thank you so much.
Thank you.
Thank you.
Bye-bye.
Take care.
Very
Bye.
much.